So hello all my dear students of CA Final Direct Tax from South India especially. I hope you all are doing good and I hope your studies are going on great. So as I promised you some days before that I'll be making a full English video also along with a Hindi video. Don't worry about it. On all the past RTPs, that is 6 RTPs, 8 mock test paper and 5 exam paper, total 19 papers. We'll try to revise all of them in what? In a span of around 2.5 hours to 3 hours in full English also along with Hindi. So the time has come for that, and this video will be applicable for your May 23 exams and also for your November 2023 exams. Okay. So without wasting any further time, so let's start with the first RTP, that is November 2022. And in the first RTP, the first key point over here is given in the first line. There is a word manufacturing over here. Whenever the word manufacturing will come, you have to come to one conclusion that there can be an implication of additional depreciation. Apart from that, wherever there is a business of footwear, leather, apparel, footwear, leather, apparel, always remember that there can be an implication of 80 JJAA, that is the employment wala section under chapter 6A. So now this is a normal question on PGBP where you have to compute your total income and then the tax liability. Now the total income has to be computed as per the normal provisions. No 115BAA, no 115BAB, nothing has to be followed. It has to be computed as per the normal provisions. Further, no MAT implications have to be applied. Nothing has to be done. Plus, the tax rate would be 25% because the turnover of last year is up to 400 crore. It is less than 400 crore. Therefore, the tax rate over here will be 25%. Okay. Now, coming to the computation of income. The very first adjustment over here is depreciation. The depreciation is very simple. You have to add back the company's Act wala depreciation 64 lakhs. Second adjustment, you have purchased some goods of 64 lakhs, out of which 52 lakhs is settled and 12 lakhs is remitted and it is waived off by the other person. If it is remitted by the other person, it is nothing but deemed income under section 41(1). Okay. So if you have purchased goods of 64 lakhs and if the other person has remitted 12 lakh rupees, so that is your income, nothing but deemed income under section 41(1). Next one is employer contribution to employees provident fund. Employer contribution, you can make the payment till the due date of filing of return, that is till the due date of filing of return. This is a company, therefore for company the due date of filing of return is 31st October. So if it is making the payment in 30th June, it is well and fine, it is allowed as a deduction. But employees contribution has to be made as a payment by 15th of the following month. That is given in the last adjustment, in adjustment number 4. And in that case, the employees contribution is made as a payment on what? Is made as a payment on 31st July. That will not be allowed. That will be added back to the income. Employer contribution, you can make the payment till what? Till the due date of filing of return. But employee contribution has to be made as a payment by 15th of the following month. So here they have made a mistake, and in case of employer contribution, they are not making any mistake over there. They are absolutely fine over here. Now, the most important adjustment and the crux of this question is given in adjustment number 4. Here you are making an interest payment of 60 lakhs. Out of that interest payment, there is a loan of 50 lakhs which you have taken for the purpose of purchasing of machinery, and that machinery is not put to use. That machinery is put to use in November. So till 31st October, you have to what? Capitalize the interest. So interest will come to how much? 50 lakhs is the loan for machinery, multiplied by 12% is the rate of interest, multiplied by 7 months, divided by 12. So that much, that will come to 3.5 lakhs. So that 3.5 lakhs you have to add back to the cost of this new machinery, which is given in adjustment number 2 below. So 60 lakhs plus 3.5 lakh, you have to add back to the cost of the machinery. Now there are multiple adjustments in this particular point. First, this 3.5 lakh will be added to the cost of machinery. At the same time, you also have to add back that to the P&L back, because it is also debited to the P&L. You cannot take both the benefit now, that you will add to the asset and claim depreciation also, and you will claim as a revenue expense also. You have to add back to the P&L account. Okay. So that interest, which is a pre-use interest, that has to be added back to the P&L. Okay. So first effect is you have to add back to P&L. Second effect is you have to add back to the asset. Now you can claim normal depreciation. How much? 7.5%. Why? Because the asset is used for less than 180 days, and you will also compute what? Additional depreciation, because it is a new machinery and the assessee is engaged in manufacturing. Therefore, you will also compute additional depreciation at the rate of 10%. Okay. So you have to think all these things in your mind. So normal depreciation will be half and additional depreciation will also be half, and this is the effect of this particular machinery. Now the balance machinery, 340 minus 60 lakhs, the balance is 280 lakhs. The 280 lakhs machinery will be depreciated at normal rate of 15%. That is your opening WDV. Okay. Now, building will be depreciated at 10%, as we all know. Computer will be depreciated at 40%, as we all know. These are all opening WDV of the assets. Okay. Next is you have made some payment of 20 lakhs without deduction of TDS. So in that case, you have to disallow 30% of that. That is 6 lakhs will be disallowed in that particular case for not deducting the TDS of payment made to residents. Okay. Next. Adjustment number 3 is about what? Adjustment number 3 is about the 80 JJAA deduction. You have employed 24 additional employees. Now, out of these 24 additional employees, how many of them will be allowed as deduction? Now, first of all, you have to keep it in mind that in 80 JJAA, it is only allowed if the emolument per month is more than up to 25,000 rupees per month. So if the emolument per month is more than 25,000 rupees, then it is not allowed as deduction. So out of 24 employees, 12 employees are employed on 1st June and their emoluments is 23,000. So they will be eligible for 80 JJAA. But out of those 12, 2 employees who have joined are settled by bearer check. You cannot make the payment by bearer check. You have to make the payment by account pay check, account pay draft, ECS or such an electronic mode. Bearer check is not allowed. So out of this 10 employees also, 2 employees are disqualified. So out of this 12 employees also, 2 employees are disqualified. They are not eligible for 80 JJAA. So out of this first lot of 12 employees, how many employees will be eligible? Only 10. Into 23,000 is their salary per month, multiplied by, from June to March, it will come to 10 months. This is the first lot of employee. Okay. Second lot of employee. These 4 employees who are joined on 1st July, their emolument is more than 25,000. So they will not be eligible for deduction under 80JJAA. Next 8 employees who have joined on November, that is in the month of 1st November 2022, their salary is less than 25,000. They will be eligible for 80JJAA. So there are only 2 lots of employee. These 10 employees are eligible, and then these 8 employees are also eligible. These 8 employees are eligible for 20,000 into 8 into 5 months from November to March. So that will come to whatever amount comes to, you have to take 30% deduction of that. Okay. And last but not least, which I have already told you, that employees contribution has to be paid by the 15th of the following month, and you are making the payment in 31st July. That is not allowed, not allowed, not allowed. Okay. Forget about it. Now, what is the total income of the assessee? The total income of the assessee is more than 1 crore rupees. Now, because it is more than 1 crore rupees, the assessee would also be liable for what? Surcharge of 7% on the total income. You can check it over here. Okay. So this is your first question, which is very, very, very important question. The next question is based on what? Is based on accredited income. And in accredited income, what happens in exit tax? What happens? Your aggregate of all assets minus aggregate of all liability will be subject to 34.944% tax. Do you remember that? 34.944% tax. Now, what should be the value of the asset? For land, you have to take the stamp duty value or market value, whichever is higher. So we are taking market value because market value is higher. For equity shares which are listed in a stock exchange, you have to take the average of the higher of the price. Average. So 150 is the lower, 170 is the higher. So divide by 2, average will come to 160. 160 into 75,000. You have to take the average of the price of these shares. Okay. In case of preference shares, you have to take what? FMV of the preference shares. So the FMV of the preference shares is how much? It is 88 lakhs. So you have to take 88 lakhs over there. Now, corpus fund you are not supposed to consider. Assets are over. Only 3 assets are there. Corpus fund you are not supposed to take because capital and reserves are not part of what? Exit tax. Then outside liability you are supposed to consider. Provision for tax is not allowed to be taken in the list of liabilities. Then the other utility bills which you have paid for electricity, for rent, etc., that outstanding bills also you can take in the list of liabilities. Okay. After you do all these things, you will get your accredited income. On that apply 34.944% tax. Okay. The third question is a theory question, which is based on a person who is a resident, whose age is 60 years. He is resident and ordinary resident, and his total income is what? His total income is 3 lakh rupees. Now he is asking, am I supposed to file the return? By default, if a person whose age is 60 years, for him the basic exemption limit is 3 lakh and he is not liable to file the return. But if he has a foreign asset, or if he is a signing authority in foreign country in a bank account, then he is liable to file the return. This Mr. Suresh is having a foreign asset and he is also having a bank account in foreign country where he is a signing authority. Therefore, Mr. Suresh is liable to file the return as per the 4th proviso to section 139(1). I hope you all know that. That is a very, very important provision. Next question is based on what? Is based on, there was one assessee who has filed the return. After filing the return, assessments are done. In the assessment, there are 2 mistakes, there are 2 additions made by the assessing officer, out of which one addition is some unexplained investment that AO has added back, and second is excess remuneration paid to the partners as per 40B that AO has added back. So these are the 2 additions that AO has added back. Out of that, the first mistake, assessee has challenged. Assessee has challenged the first mistake in the court. Okay, and the matter has gone to CIT appeal, and CIT appeal has decided that matter. Now the assessee wants to challenge the second matter also. So the assessee has 2 options, given in the question. Can the assessee go for 264 revision, or it should go for 154? 264 is close. Why? Because their doctrine of complete merger is applicable. Once a particular matter of an order is subject matter of appeal or revision, then the entire order is not subject to revision under 264. 264 door is closed. Yes, you can go for 154, provided the second mistake is a mistake apparent from record. If it is a mistake apparent from record, you can go for the second one. Okay. Now, next. Question number 5 is on section 292BB. 292BB is attracted in 3 circumstances. First, if the department has given a late notice, or if the department has given an improper notice, or if the department has not given the notice only. These are the 3 circumstances which are mentioned in 292BB, whereby if the assessee cooperates, then the notice is deemed to be valid. But the Supreme Court in the case of Lakshman Das Khandelwal has held that the 292BB cannot be attracted if the notice is not given to the assessee. If you want to attract 292BB, the notice has to be given to the assessee, and in that case, the notice can be late, the notice can be improper. But if you have not given the notice and then you want to attract 292BB and say that the assessment is deemed to be valid, you cannot say that. To attract 292BB, the department has to send the notice. Without sending the notice, 292BB cannot be made applicable. Next question number 6. What is question number 6, sir? Question number 6 is on transfer pricing provisions, whereby we need to say whether the transfer pricing provisions will be applicable or not. And to make a transfer pricing provision applicable, there has to be a relationship of associate enterprise between 2 entities. Unless and until there is a relationship of associate enterprise between 2 entities, you cannot say that the transfer pricing is applicable. Now, in the first case, what is happening? One entity is giving more than 10% guarantee of the total borrowings of the other entity. Therefore, both of them are deemed to be associate enterprise. Second one is not relevant because 115BBD is removed from this financial year, therefore second one is not relevant. Third one is based on domestic transfer pricing. One entity, one unit of the entity is in ATIA, highway project. Highway projects are eligible for ATIA deduction, and other unit of the SSC is in other than ATIA. It is a non-eligible unit. So do you remember that if there is a transaction between ATIA SSC and non-ATIA SSC within India also, then also domestic transfer pricing is applicable if the aggregate value of transaction is exceeding 20 crore rupees. Otherwise not. Okay. And the last one is if there is a holding and subsidiary, then the relationship of holding and subsidiary is deemed to be a social enterprise, and therefore transfer pricing provisions will be applicable in that case also. So can you see this? Just in 10 minutes we have completed one RTP. In this way, in 190 minutes we'll try to complete the entire 19 papers. Okay. So let's move on to the next RTP, that is May 21 RTP, in which the first question itself is based on non-resident taxation, your favorite topic. Okay. Now, the first question over here is based on NR taxation, in which there is a foreign company who is providing some fees for technical services to an Indian company, and there is an agreement between both of them, and the agreement is also approved by the central government. Now, if all these conditions are fulfilled, then either of the two sections will be applicable. Either 115A will be applicable or 44DA will be applicable. Now, 115A will be applicable if there is no PE of the foreign company, and 44DA will be applicable if the foreign company has a permanent establishment in India. So the first part is about that only, that is there is no, assume that the foreign company does not have a PE in India, and compute the income and compute the tax. So if the foreign company does not have a PE in India, the income will be directly 3.2 crore. And the deduction of expenses will not be allowed to the SSC. No deduction of expenses will be allowed under 115A. The tax rate will be 10% plus surcharge will be 2%. Why 2%? Because the income is more than 1 crore and up to 10 crore. It is 3.2 crore. Now it is more than 1 crore up to 10 crore. Then the surcharge to foreign company is 2%, and about 10 crore the surcharge to foreign company is 5%. So therefore the surcharge over here will be 2% plus 4% cess will be applied to the SSC. Now one more question is asked over here. Second thing is they will not get any deduction of any expenses over here. Directly 3.2 crore will be taxed at 10% plus 2% plus 4%. Now the second question asked in this particular point number 1 is the SSC liable to file the return? No, SSC is not liable to file the return. SSC is not liable to file the return because the SSC does not earn any other income, and the tax is not deducted at the rate lower than the rate mentioned in 115A. If there would have been a rate mentioned under DTAA, suppose if the DTAA says that the FTS would be charged at 5%, and if the SSC would have paid the tax at 5%, which is lower than the rate mentioned in 115A, then the SSC would have been liable to file the income tax return. In this case, if the SSC does not earn any other income and it is taxed at the rate mentioned in 115A, which is taxed over here as per the rate of 115A, therefore there is no need to file the return over here. In the second case, we have to follow 44DA because the SSC has a PE in India, therefore you have to follow 44DA. And as per 44DA, there are two incomes which are going to come over here. First is 3.2 crore is the revenue FTS, and another FTS which is earned of 2 crore. These are the total income, total revenue which has been earned by the SSC. Now, in 44DA, you get expenses, deduction of expenses. You will first of all get this deduction of 28 lakhs incurred for earning such income, then this 21 lakhs incurred for earning such income, but you will not get this 8 lakh rupees deduction. Why? Because in 44DA, it is very clearly written, if an expense is incurred not wholly and exclusively for this branch, for this PE, then it is not allowed. If it is commonly incurred for this branch and for HO and for other branches, then it is not allowed. The expense should be exclusively incurred for the Indian branch, then only it is allowed. Now this is not allowed because this is not wholly exclusively incurred for the Indian branch. Second one, this 14 lakhs will also be not allowed. It is very clearly written in 44DA, you can check. If the SSC, if the Indian branch is making payment to its HO or to any other branch, then it is not allowed as deduction. Yes, if it would have been a reimbursement of expense, then it would have been allowed. But this is not a reimbursement of expense. This is the direct expense paid to what? HO. This is considered to be a payment to self, and therefore this is not allowed as deduction, not allowed as deduction. If this would have been reimbursement, then this would have been allowed under 44DA. Okay. Now, one last thing. What would be the tax rate? The tax rate will be the normal rate which is applicable to a foreign company, that is 40%. Okay. Now, is the foreign company liable to file the return? Yes, they are liable to file the return. They are liable to maintain books of account. They are liable to do the tax audit as per 44AB, and also they are supposed to submit the tax audit report 1 month prior to the due date of filing of return. Okay. So these are the other requirements which are asked in this particular question. Let's move on to the next question. The next question is a very traditional question of what? Of computation of penalty. First of all, this is an LLP, therefore the tax rate would be 30%. Second thing, this is not a case of misreporting, therefore the penalty would be 50%. If it would have been a case of misreporting, then the penalty would have been 200%. Now, how penalty is computed? Here you have to compute penalty at two stages. First, when you are doing a regular assessment, at that time you have to compute the penalty, and then you have to compute the penalty when you are doing the income escaping assessment. To compute penalty, first of all, you have to compute the underreported income. Underreported income is nothing but what? Your income assessed, which is 35 lakhs, minus income processed, which is 22 lakhs. So 13 lakhs will become your underreported income, and now you will not directly compute tax on 13 lakhs. Be very careful. First of all, you will compute tax on underreported income plus income process, minus then you will compute tax on income process. You have to compute the tax in this step. Okay. Similarly, when you are doing a reassessment, at that time your underreported income will be income reassessed, that is 45 lakhs, minus income now previously assessed, that is 35 lakhs. Therefore 7 lakh will become what? Your underreported income. Again, you are not going to compute tax on 7 lakhs directly. You are going to compute tax on what? Underreported income plus previously assessed. First compute tax on underreported income, that is 7 lakhs, plus previously assessed, that is 35 lakhs. First compute tax on 42 lakhs, minus then compute tax on what? tax on previously assessed. You are not going to compute tax directly on 7 lakh. Be very careful, otherwise your answer might go wrong in some cases. Okay. After that, you will compute the tax, and tax is 30% for LLP, 4% cess. If surcharge is applicable, apply surcharge also. Then you will compute penalty at the rate of what? 50%, because this is not a case of misreporting, it is a case of underreporting. Question number 9 is based on MAT, book profit, book profit, book profit. We are supposed to compute the book profit, and after computing the book profit, we are supposed to compute the MAT liability. So they have given us the net profit. The net profit is 52 lakhs. You will write down that first, and you will add less all the items which are added in explanation 1 to section 115 JB. Now, provision for loss of subsidiary, yes, it is added back. Provision for doubtful debts, yes, it is added back. Income tax, yes, it is added back. Provision for gratuity based on actual valuation, no, it is not added back in MAT, because it is a certain liability. What is added back in MAT is a provision for that liability which is unascertained. Gratuity liability determined by what? Actually is an unascertained liability. Do not add in MAT. In normal provision back, it will be added back. Do not add over here. Be very careful. This is an important point. Depreciation you have to add back, and then you have to reduce the depreciation other than revaluation. And now your revaluation is 80,000. Therefore, your other than revaluation is 2,28,000. So out of 3,08,000, 80,000 is depreciation because of revaluation. You cannot reduce that. So remove that much. And therefore, depreciation other than revaluation is 2,28,000. You can reduce 2,28,000. So for depreciation, add back 3,08,000 and then reduce 2,28,000. Okay, very simple. Next two items are not added back in MAT. Those two items are added back in the normal provision. Not in MAT, not in MAT, not in MAT. Okay. Now 15,20,000 SEZ deduction. 10 AA deductions are not reduced in MAT. Let it be part of book profit. Let it bear the burden of MAT. 10 AA deductions are not subject to deduction from MAT. They are liable for MAT. Liable. Do not reduce this. Do not reduce this. Okay. Next, share of income from AOP as a member. Now this company is a member in an AOP. And if it is earning some share of income from that AOP, then that has to be reduced from MAT, reduced from MAT, reduced from MAT. The way the share of profit from a firm is reduced from MAT, same way the share of profit from an AOP is also reduced from MAT when the AOP has paid tax at MMR. And it is written in the question that AOP has paid tax at MMR. If the AOP has already paid the tax at 42.744, then on that share, the income is exempt under section 86 under the normal provision. And in MAT also, it is not liable to tax, not liable to tax, not liable to tax. Long-term capital gains are subject to MAT, subject to MAT, subject to MAT. They will be liable to MAT. Then the UAD is 18 lakhs and unabsorbed depreciation, and the loss is 14 lakhs. So whichever is lower will be reduced from the book profit. So the lower amount is what? 14 lakhs. You can reduce 14 lakhs from your book profit. Okay. Your provision for tax includes interest also. Let it be part of, because interest is also added back in MAT and provision for tax is also added back in MAT. So there is not going to be any adjustment regarding this, because provision for tax is also added back, interest is also added back on income tax. So let it be part of that. Don't worry about it. After doing all these things, you are going to compute 15% tax, 4% sex, no surcharge because the income does not exceed 1 crore rupees. Second part, would your answer change if Ganga is a unit located in IFSC? Yes. If the Ganga is a unit located in IFSC, then the MAT liability will be 9% instead of 15%. Do you remember that? In IFSC, the MAT liability and the AMT liability is 9% and not 15%. Okay. Last but not least, if Ganga is a unit located in IFSC and derives income solely in convertible foreign exchange, what will be the tax distributed by it in the hands of the Ganga and shareholder? So if the Ganga is distributing some dividend, then no DDT on Ganga, because DDT is removed from Fund 4 2020, and no income tax to the shareholders also. If the IFSC unit is distributing dividends, that dividend is exempt in the hands of shareholder. Be very careful. If an IFSC unit is distributing shareholder, that dividend is exempt in the hands of shareholder. So this is what this question is all about. Let's move on to the next question, question number 10, which is almost similar to the question which we have done in the previous RTP. That is based on what? Charitable trust, which is converted into a business trust, into a business now. Therefore, we have to apply the exit tax, accredited income tax at 34.944%. Now, one important point in this question is, in 2013, the trust was set up, the trust was started, but it was registered in 2016. So from this date to this date, whatever assets are purchased by the trust, that will not be subject to accredited income. Be very careful, because there is an exclusion. There is an exclusion in the law which says that if the asset is purchased from the date of setup of the trust till the date of registration, then that asset will not be subject to accredited income. Therefore, this Surat land will not be subject to accredited income because it was purchased before the date of registration. Therefore, this land will not be subject to accredited income. Yes, this Baroda land will be subject to accredited income, and for the purpose of accredited income, you have to take the stamp duty value or market value, whichever is higher, and therefore here the market value is higher. Therefore, we are taking 105 lakhs for land of Baroda. Surat land we are not going to take. For equity shares which are listed, you are going to take the highest price and the lowest price average divided by 2 multiplied by 3,000 shares. For preference shares, you are going to take the market value multiplied by number of shares. And for liabilities, you are going to take the total liabilities, but in that you cannot take corpus fund, you cannot take provision for tax, as we have seen in the previous question also. You cannot tax reserves and surplus. All these things are not part of what? Liability for the purpose of computation of accredited income. And one last question, question number 11 in this particular RTP is based on DTAA. There is an assessee, Mr. Sham, who is having an age of 47 years and he's a resident individual. Now, this assessee is what is computing his income, and he is trying to take some unilateral relief because the India does not have DTAA with the foreign country. So we have to compute a unilateral relief. The first income which he is earning is he is earning some profit from business in Noida. So that is 50 lakhs. Second, he is earning some share of profit from a partnership firm in Gurgaon. That is exempt under 10(2)(a), because if your partnership firm is in India and you are earning some profit out of it, that is exempt under 10(2)(a). Third one is he is earning some agriculture income from what? Country A. So that you have to write over here. Agriculture income will be chargeable under income from other source. So the dollar rate is given at 60 rupees, so 32,000 into 60. Fourth is there is some loss of business which is not allowed to set off in country A. So in country A it is not allowed now, but in India it is allowed now. So you can take the deduction of that loss against the Indian business. In India it is allowed. In country A it is not allowed. But in India the loss is allowed now. Business loss is allowed. In country A it is not allowed. Forget about that. Don't reduce against this income, but against Indian income you can reduce now. You reduce that. After that, he has paid some PPF, 1,50,000 he will get. He has paid some 30,000 to insure his health in ATD, but he will not get 30,000 because his age is less than 60. He will get only 25,000. Plus, he has paid some 55,000 insurance premium for his parents. So for that also, he will get only how much? Only 50,000. Plus, there is one sister who is dependent on him, and the sister is not claiming ATO. Therefore, he can claim, and that sister is disabled. Therefore, he can claim what? ATDD, 75,000 flat deduction. He can claim in ATDD, and therefore he will get 75,000 flat deduction under ATDD. After doing all these things, he have to compute what? He have to compute his tax. He will also apply surcharge over here because his total income exceeds what? Exceeds 50 lakh rupees. So he has to apply 10% surcharge over here, and then he will compute the tax rate. The Indian tax rate is 30%, 31% approximately, and the foreign tax rate is 25%. Whichever is lower will be allowed as benefits. Therefore, 25% will be the relief. On how much income? On doubly taxed income. How much is doubly taxed income? This is your foreign income, but out of that you have to reduce 2,40,000 because that much is not doubly taxed. That much you are taking benefit in India. Therefore, out of that amount you have to reduce 2,40,000, and therefore the remaining amount will be your doubly taxed income. On that you will apply 25%. That will be your relief. That's it. This is your RTP May 2021. So let's move on to the next RTP, that is RTP November 21, question number 12. It's a beautiful question. It's a question on two companies, company X Limited and company Y Limited, and we are supposed to compute three different parts are there over here. First part is compute tax liability of X and Y as per the beneficial rate, that is 115BAA or 115BAB for previous year 2021, assessment year 21-22. Be careful, this question is for previous year 2021, assessment year 21-22, so accordingly you have to compute the answers. Okay, so first of all we have to compute the tax liability of both the companies as per the special rates. So which special rates will be applicable? There are two special rates. One is 115BAA, 115BAB. Now 115BAB is not applicable to both of them. Why? Because this company was formed in 2018. So therefore 115BAB is out of question. 115BAB is applicable if the company is formed from 1st October 2019 to 31st March 2024, and it should be a manufacturing company. Therefore this company is out of question. Even the second company is out of question because 115BAB is not applicable to second company also. Why, sir? Because sir, this company is formed after 1st October 2019. Why this company is not eligible for 115BAB? It is not eligible because of some other reason. That is because of printing of books. If an assessee is engaged in printing of books, software development, if an assessee is engaged in marble blocks, etc., there are certain 4 or 5 businesses for which 115BAB is not applicable. So moral of the story, both the companies are not liable for 115BAB. Both of them will be liable for 115BAA, and in which the tax rate is 22%, surcharge is 10% always, and 4% cess. Now, we need to be very careful how to compute the income. In 115BAA, you do not get any deductions of chapter 6A except some, like 80JJAA you get, 80M also you get. 80JJAA and 80M you are supposed to take. Additional depreciation not allowed, not allowed, not allowed. Okay, so therefore the first thing is we have to write the gross total income of both the company, and then we have to take 80JJAA and 80M for both the company if it is available. So for the first company, the employees are 150 employees are there, 18,000 per month, multiply by 12, then 22,000 rupees, 150 employees into 12. For this 26,000 rupees, you are not going to get the deduction because again and again it is repeating now. If the emolument is more than 25,000 rupees, you are not eligible for deduction under 80JJAA. So you are eligible for the first two category of income, not for the third one. Okay. Secondly, this company is also eligible for what? It's also eligible for 60 lakh rupees deduction on ATM. Do you remember that? If you receive dividend from domestic company and if you distribute dividend to another to your shareholders 1 month prior to the due date of filing of return, then you are eligible to claim deduction under ATM for whichever is lower. So you are receiving dividend of how much? 60 lakh. You are distributing 1 month prior to the due date of filing of return, how much? 72 lakh. You will be eligible for deduction of how much? 60 lakhs over here. Now, the second company Y Limited is not eligible for deduction under 80JJAA. Why? Because the company is formed in the current year, that is 2021, and the company is formed in October 2020, and therefore the employees who have been employed during the year, that is the 200 employees who are employed during the year and employed for less than employed for less than 240 days, and therefore they will not be eligible for what? 80JJAA. 80JJAA will not be allowed to this company in the current year. Plus, ATM is also not applicable because this company is not distributing any dividend nor receiving any dividend. Therefore, the total income of the first company is this, second company is this, and on that you have to apply 22% flat tax, 10% surcharge. Always in 115BAA, surcharge is not based on income, it is always applicable. For plus 4% cess always. Okay, that is your tax liability. This is the first part. What is the second part? Compute the total income as per the regular provision. Now, in regular provision, there is only one extra thing that you are going to get. That is, in this question, you are going to get what? Additional depreciation. Now, additional depreciation is only available if you follow what? WDV. So, the company is following WDV from financial year 18-19. Earlier, it used to follow what? SLM. But now they want to, because the company is engaged in the business of generation of electricity, now they have both the options. They can follow SLM also, they can follow WDV also. But this company has now been following what? WDV. Therefore, they are eligible for what? Additional depreciation. Therefore, the company X has purchased new plant and machinery of 9 crore on 1st October 2020 and it has used immediately. Therefore, it is eligible for full additional depreciation because it is used for more than 180 days. Similarly, company Y is also purchasing what? Is also purchasing a plant and machinery of 2 crore rupees. You can see over here, which is also put to use from 1st October 2020. They are also eligible for full depreciation because it is both the machineries are used for more than 180 days. Therefore, this machinery 9 crore into 20%, 1 crore 80 lakhs and 2 crore into 20%, it will come to 40 lakhs. Therefore, you will get this deduction. Rest of the deductions are same only. This is your total income. This is your part 2. And in part 3, they are saying that part 3 is only for X, it is not for Y. They are saying that whether it should opt for special provision or it should go for normal provision. Now remember, if you opt for special provision, your tax liability is 96,64,510. I am talking about X because part 3 is not for Y. And in special provision, you are not liable for MAT. No MAT is applicable when you follow 115BAA. Assessee opting for 115BAA are not liable for MAT. Therefore, your final tax liability will be 96 lakhs, 97 lakhs approximately. But if you follow the general provision, what is the advantage over there? The advantage over there will be that you will be, what is the disadvantage? Sorry, not advantage. You also have to follow what? MAT. Then for that, you need to compute the book profit. The book profit is given in the question as 4.2 crore. So now we will compute tax liability as per both the provision and then we'll see which is more beneficial. So as per 115BAA, we know that the tax liability is approximately 97 lakhs. So let's compute the tax liability as per the general provisions. As per the general provision, your income is how much? Your income is how much? 61,20,000 that we have computed here. Okay, that we have computed here. As per the general provision, your income is 2 crore 4 lakh. On 2 crore 4 lakh, your tax rate will be 30% because your turnover of last year is exceeding 400 crore. You can see in this question over here, your turnover of last year. For you, the last year is 2018-19 and in 18-19, your turnover is how much? 402 crore. And because your turnover is exceeding 400 crore, you will be liable for 30% tax. So you will be liable for how much tax? 30% tax over here. 30% tax plus 7% surcharge because your income is more than 1 crore and 4% cess. Therefore, as per the normal provision, the tax liability is coming to approximately 68 lakh. The book profit is directly given in the question as 4.2 crore. 15% tax, 7% surcharge because the income is more than 1 crore. 4% cess. The book profit tax is coming to 70 lakh. Whichever is higher is this. So therefore, as per MAT, you are supposed to pay tax as per 70 lakhs. Therefore, it is beneficial to go for this particular thing rather than to go for what? Special provision and pay 96 lakhs. What sense does it make to pay 96 lakhs? Rather than that, go for the normal provision and pay tax as per 70 lakhs, 10,640. Check it, please. And first, further, you will also get a MAT credit of 2 lakhs over here, which you are not going to get over there. You can carry forward this MAT credit and set off against subsequent year's income. So it is better you go for the normal provision rather than what? The 115BAA. Okay. Now, let's come to the next question. The next question is based on trust. In this, there are 3 parts. First part says that the trust is registered as what? Any other object of general public utility. Now, you remember that if the trust is registered as any other object of general public utility, then the commercial receipt cannot exceed 20% of total receipt. Now, this trust commercial receipt is how much? 44 lakhs. The total receipt is how much? 200 lakhs. Therefore, the commercial receipt is exceeding 20% of total receipt. Therefore, the trust will lose its exemption for the current year. It is not going to get the exemption in the current year. Second question is based on what? Some rent paid by the trust. Now, if a trust is paying some rent, then they are liable to deduct TDS. If they don't deduct the TDS, 30% of the expenditure will be disallowed. Now, the trust is paying 12 lakhs in the current year and 15 lakhs in the next year. Okay, 12 lakhs rent is paid in the current year, 15 lakhs rent is paid in the next year. And for both the rent, they are deducting TDS in the next year. So if for both the rent, they are deducting TDS and making payment in the next year. So in that case, the 12 lakhs rent, for that, you have to disallow 30% in the current year because for 12 lakh, you are making payment in the next year. So for on 12 lakhs, 30% comes to 3,60,000. That 3,60,000 will be disallowed in the current year. And because it is paid in the next year, it will be allowed in the next year. And for next year rent, you are making the payment in the next year before the due date of filing of return. So for next year rent, you will get the deduction of next year rent directly in the next year itself. Okay. So for next year rent, there will not be any disallowance. Third case, a trust was there which was registered as a relief of poor. Now suddenly they change their object to any other object of general public utility. So if you are changing your object or if you are adopting a new object, then you have to make an application to the Commissioner of Income Tax within 30 days. If you don't do that, your trust will lose its exemption. Okay, and your registration certificate will go, and therefore on you a credited income concept will be applicable because you are no longer a trust now. You are losing to be a part of trust now. So now you will be liable for what? Accredited income as per the provisions of section 115 TD as per this question. Okay, next question. Question number 14 is based on a case law of Supreme Court of Bombay High Court, sorry, of 2016. 16, which says that there was an assessee who was claiming deduction under ATIA, and suppose the deduction under ATIA was 50 lakh rupees. Okay, the gross total income was 50 lakhs and the deduction under ATIA was also 50 lakhs. Now suppose AO disallowed certain expenses and made it 70 lakhs. So suppose the AO added 20 lakh rupees. So the whatever income the AO is adding, will that also be liable for what deduction under ATIA? The Bombay High Court said that yes. Even the CBDT circular said that whatever income is added by AO in the form of disallowance, that will also be liable for what? That will also be eligible for what? Deduction under what? ATIA. Don't worry. Next question, question number 15 is based on transfer pricing provision, and in this there are 4 parts. The first part says that whether transfer pricing provision is applicable or not. Definitely it is applicable. One entity is Indian company, another entity is non-resident. Indian company has an asset of 60,000 crore and the non-resident has given a loan of 30,800 crore. How 30,800 crore? 350 crore into 88 rupees. That will come to 30,800 crore. So out of the total asset, 51.33% is financed by a non-resident. So both of them are deemed to be associate enterprise, and if both of them are deemed to be associate enterprise, both of them will be liable for what? Transfer pricing provision. The second part is what is the primary adjustment to be made over here? Now you are taking loan from your associate enterprise at 9%, whereas others give you loan at what? At 7%. So you are making payment of 2% extra. Therefore, 2% extra has to be added back. So how to compute 2% extra? 30,008 crore is the loan you have taken. Multiply by 2% extra. That will come to 616 crore. That will be added back to your book. That will be added back to your transfer pricing provisions. Okay. Now, third part. You need to identify the secondary adjustment over here. You need to elaborate on secondary adjustment, assuming that the primary adjustment is made suo motu by the assessee. Now, if the primary adjustment is made suo motu by the assessee, then the secondary adjustment will not be made if the amount is brought back to India within 90 days from the due date of filing of return. If the assessee does not bring back the money to India within 90 days from the due date of filing of return, that is till 20th Feb of the next year. Suppose if you are making the suo motu disallowance, if the due date of filing of return is 30th November 2022, then you have to bring back the money to India till 20th of Feb 2023. If you do not bring back the money to India till 20th of Feb 2023, you will be liable for what? Transfer pricing provision over here. How much provision, how much tax will be imposed over here? How much will be the secondary adjustment? It will be nothing but that is the 616 crore. That is the secondary primary adjustment multiplied by LIBOR. Why LIBOR? Why LIBOR? Because the transaction is in foreign currency. Therefore, multiply by LIBOR plus what? Apart from LIBOR, plus what? 3% extra will be imposed, and the interest will be charged from 30th November 2022 and not from 20th Feb 2023. Be very careful. Can I make one-time settlement with the government? That is part 4. Yes. On this primary adjustment, you can make a payment of 18% tax, 12% surcharge, 4% cess, and that will be one-time settlement. That one-time settlement 20.9664% if you pay, then the government will not do secondary adjustment on that transaction. Okay. Next question, question number 16 is on transfer pricing. Sorry, is on non-resident taxation. There is a non-resident over here who is providing some FTS services to an Indian company, and there is an agreement, and that agreement is approved by central government. And there are multiple parts in that. In first part, it is said that India does not have DTAA with that country. So in that case, the FTS will be charged at how much? FTS will be charged at how much? It will be charged at 10% as per 115A plus surcharge if applicable, and 4% cess will be applicable always. Okay. Now, is the non-resident liable to file the return? Non-resident is not liable to file the return if the TDS is deducted. If the TDS is deducted, non-resident is not liable to file return because non-resident does not earn any other income apart from this FTS income, and the TDS is also deducted and the tax rate is also 115A. If the tax rate is lower than 115A, then the non-resident is liable to file the return. In this case, the non-resident is not liable to file the return over here. Okay. Second part, what if the FTS is 8%? Then the TDS will be deducted as per 8%. Then in that case, the non-resident has to prove that, because now you are applying the DTAA rate. The non-resident has to produce what? The tax residency certificate, TRC. Along with that, other documents and information will also be asked by the Indian tax authority. You have to give all that tax information to the tax authority. Then only you will get the benefit of 8%. Is the non-resident liable to file the return? Yes. Because the tax rate is lower than the rate mentioned in 115A, the non-resident is now liable to file what? Return under this case. In third case also, the third case is same as the first case only. First case and third case, there is no difference between third case and first case. And the last thing over here is assume that if the non-resident has what? Assume that if the non-resident has a fixed place of business in India, then what will happen? If the non-resident has a fixed place of business in India, then 115A will not be applicable, then 44DA will be applicable, and all the provisions of 44DA shall apply because it has a fixed place in India. Therefore, all the expense will be allowed, but certain expenses will not be allowed. Suppose if an expense is not incurred only and exclusively for Indian branch, then it will not be allowed, and there are certain other expenses which will not be allowed to compute the total income. Are they liable to file the return? Yes, they are liable to file the return. They have to maintain books of account. They also have to conduct tax audit as per the provisions of 44AB. Okay. So let's go on to the next RTP, that is May 2022 RTP. This is the fourth RTP which we are doing over here. Now the first question is based on slum sale, and in slum sale you are selling one of the unit, that is Delta Limited, that is you are selling your Omega unit to someone. Okay, at what price you are selling? At 600 lakhs, and this unit is a long term unit because this unit was formed in 2010, therefore the unit is long term. But it doesn't matter whether the unit is long term or short term, indexation benefit is not going to be available in slum sale. I hope you know that. In slum sale, you have to compute your sale consideration and your cost. Your sale consideration is FMV1, FMV2, whichever is higher, and your cost is your net worth. First, I am computing the cost. In cost, what all things will come? First of all, fixed asset, land. Land will be valued at book value as per the net worth calculation. Okay. Then comes the other fixed asset, that is your tangible fixed assets like plant machinery. That will be valued at WDV as per income tax law. So I will take 155 lakhs. Then for debtors, I will take book value, that is the balance sheet value, and for liabilities also I will take book value, that is 45 lakhs. I will get my net worth. Okay. Now, while computing the FMV1, you have to be very careful. While FMV1 is nothing but the assets which you have transferred to the other person, that is which you have transferred to Delta. Okay, that is the buyer. Now, for land, you have to take, now while taking the FMV, while taking the net worth, the land is taken at book value. But while computing the FMV, the land will be taken at stamp duty value. Okay, the machineries will be taken at, other assets will be taken at what? Book values, that is 230 lakhs while computing the FMV. Rest of the things will be same, that is debtors will be valued at book value, and your your liabilities will also be valued at book value. Okay, now that will give you what your sale consideration number 1. What is FMV number 2? FMV number 2 is nothing but what you have received. How much you have received? You have received 600 lakhs. Therefore, you will compare with your FMV1 with your FMV2. Your FMV1 is 627, FMV2 is 600, whichever is higher, that will become your FMV, and your cost is 540 lakhs. Then we will compute your long-term capital gains. Long-term capital gains will be charged at 20% tax, no surcharge, because the income does not exceed 1 crore. 4% cess you will apply, and that will become your tax rate. Okay, you can check it over here. Now, coming to the next question. Next question is a beautiful question. Assassi is a manufacturer which was set up in 2020, and Assassi is opting for 115BAB. So be very careful. If the Assassi is opting for 115BAB, the tax rate is 15% in some cases, 22% in some cases, 30% in some cases, and special tax rates in some cases. Now, we have to compute the total income and tax liability of this particular Assassi. First of all, Assassi is purchasing some intangible asset of 22 lakhs, and it is debited to the PNL. So add back that, and then you compute 25, and you reduce 25% depreciation as per the block method. Okay, so add 22 lakhs and reduce 22% depreciation, 25% depreciation. Next, you are making some payment in cash to goods transporter of 32,000 rupees. Can you make a payment of 32,000 in cash to a goods transporter? Yes, you can. You can make payment up to 35,000 to them. It is allowed. Okay, for others it is 10,000. For these people it is 35,000. Next is a very intelligent adjustment. You have let out your part of your office at 60,000 rupees per month. That will make your total rent as 7,20,000. First of all, reduce this rent from your PNL account. You have to reduce this. This is not a part of PNL. This is not a part of profit. It will go to house property. You have also paid a municipal tax of 8,000. You have to add back this 8,000 rupees as municipal tax to your PNL account. Okay, in your PGPP you have to add it back. And now when you go to 115BAB, you will show rent as 7,20,000. That's it. You will not take deduction of 8,000. You will not take 30% standard deduction, because 115BAB Assassi does not get all these deductions. Be very careful. 115BAB Assassi does not get these deductions. These deductions are not allowed for 115BAB Assassi. Be very careful. Next, scientific research contribution you have made, that is also not allowed. 3512, 3513, 3528, all of them are not allowed to 115BAB Assassis. Next, you have made some payment but you have not deducted TDS, so 30% will be disallowed. Okay. Next, you have received some dividend from Gamma Limited, so reduce that dividend from PGPP and show under IFRS, and that dividend will also be taxable at 22% as per 115BAB. The general income is taxed at 22% without any deductions. That will be subject to 22% tax. Okay. Next, you have purchased some shares of 100 rupees and then you sold for 280, and the whatever profit came, you have credited that to the books of accounts. So 100 rupees shares sold for 280, therefore your profit is 180 rupees per share into 1000 shares, therefore your profit as per accounts is 1,80,000. So that profit you have to reduce from your book profit accounts. Okay, from your net profit you have to reduce your accounting profit, and you have to show under capital gains. How much you will show as a cost under capital gains? You have to follow the grandfathering rule over here. What is the grandfathering rule? The FMV as on 31st Jan 2018, compare with the sale consideration whichever is lower, and then compare with the actual cost whichever is higher, and with that your cost comes to 110. That will be your cost. So therefore your cost is 110 and your sale consideration is 280, therefore your capital gains will be 170 rupees per share. That will come to 170 into 1000, that will be 1,70,000, and this will be taxed under 112A, and in 112A 1,70,000 will be taxed as how? 1 lakh will be reduced and 70,000 will be taxed at 10%. Okay. Next, tangible fixed asset depreciation, you have to add it back, and depreciation as per accounts, as per tax you have to reduce. Okay, as per tax you have to reduce. Then you have purchased some machinery, new machinery of 20 lakhs on 15th of November. You will get normal depreciation, that to half, because it is put to use for less than 180 days. You are not going to get any additional depreciation, because in 115BAB, be careful, additional depreciation is not allowed, not allowed, not allowed. Last but not least, some employees you have hired over here, and because you have hired some employees, you will be getting 80 JJAA deduction. You will get the 80 JJAA deduction for the first category of employees, not for the second and the third category because the emoluments is more than 25,000, and not for the fourth category also because the number of days the employees were employed is less than 240 days. So fourth category also you are not going to get. For the first category, you will get the deduction of what? 80 JJAA. After doing all these things, you are going to compute the tax liability. As I have told you, your dividend will be taxed at 20%, 22%. Your rental income will be taxed at 7,20,000 without any deductions, without any deduction. No municipal tax, no 30% deduction. Your LTCG will be taxed in excess of 1 lakh rupees, that is 70,000 will be taxed at 10%, and your other incomes will be taxed at 15%. 1115 EAB, 10% surcharge is always imposed, and 4% cess is always imposed. This is your tax liability. Okay, now coming to the next question, question number 19, which is based on MAT with Ind AS. So in MAT with Ind AS, you have to compute your book profit in two steps. First of all, compute book profit normally, and then compute book profit as per the OCI, that is other comprehensive income. First of all, what is your net profit as per PNL? Net profit as per PNL is 97 lakh 45 to 54,000. I will write that. Then second thing is, you have business loss, you have depreciation as per books of accounts. Generally, you have to take whichever is lower, but here you are going to take both. Why? Because the assessee has made an application to IBC. So if an assessee makes an application for IBC, very important point, then you get the deduction of both, what UAD also and brought forward loss also. Both you get if you make an application to IBC. So in this case, you are going to get the deduction of all of them. Okay. Now. There are certain items which will never be classified to P&L account. So items which are never be classified to P&L account, you have to add back and you have to reduce with some exceptions. Some items will be added back and reduced in the year of sale. Okay, that which are those items that I will tell you. So first of all, there is a deferred cost of hedging. You have to add this back because this will never be classified to P&L. Second, there is a changes in the fair value of equity instrument. Do not add this back because this is an exception which is given in the MAT with Ind AS concept, which says that this will be added back in the year in which it will be sold. So whenever it will be sold in that year, we have to add this back. Next, revaluation surplus of asset. Do not add this back. Do not reduce this because this is in the credit, so we have to reduce if we want to reduce it. You are not reduce this because this is also an exception. This will be reduced in the year in which you will sell that particular asset. In that year you are going to reduce. And the last two things does not come in exception, that will come in the general provision. And then for the last two things you are going to add it. You are going to reduce it from the book profit. Okay. So which item I am not going to reduce? The changes in the fair value of instrument I am not going to add, and changes in the revaluation surplus of asset I am not going to reduce because these two items will be adjusted in the year in which the asset will be sold. Okay. Now apart from this, the assessee also has some transition amount of 68 lakh rupees, but this transition amount is also including 8 lakhs of capital reserve, that is not included in the transition amount, and 6 lakhs of translation difference in foreign operation, that is also not included in the transition amount. So reduce these two items. After reducing these two items, your transition amount comes to 54 lakhs. After that, you have to divide that by 5 lakhs, and that will be allowed as deduction. That will be added back to your net profit, to your book profit for 5 years, for the next 5 years. Every year 10.8 lakhs will be added for the next 5 years. Okay. So add this 10.8 lakhs also. After you do this, you have to compute your what? You have to compute your book profit. Your book profit is 89,54. On that 15% tax, no surcharge because income does not exceed 1 crore. 4% says your tax liability will come to 13,96,824. Your tax as per the normal provision is 12,80,000. Therefore, the difference between the two will be considered to be MAT credit, which you can credit in the subsequent years. Okay. Question number 20 is on trust. There is an assessee who is saying that they are engaged in educational purpose and hospital purpose, and they have received a gross receipt of 3 crore rupees each for both of them. That is for hospital 3 crore rupees they have received, and for education also they have received 3 crore. Now, because the total is exceeding 5 crore rupees, they cannot claim exemption without making application to CIT. They have to make an application to principal CIT or CIT, then only they can claim exemption under section 1023C. Otherwise, they are not eligible to claim exemption under 1023C. Next question is what? The assessee has some excess application in the last year. They want to set off that excess application in the current year. Is it allowed? Not allowed, not allowed, not allowed. In trust, excess application cannot be carried forward and set off in the subsequent year. That is not allowed. Okay. Next, the assessee has borrowed some 40 lakh rupees from a bank and has incurred that money and has used that money for the purpose of purchasing some building, etc. Will I get the deduction? No. This will not be considered as an application. If you take a loan and then apply, it is not considered an application. Yes, whenever you will repay the loan, at that time we will give you the deduction. Therefore, the assessee has repaid loan of 5 lakh rupees. Therefore, the assessee would be eligible for deduction of how much? 5 lakh rupees in the current year. Okay. Next question number 21. In question number 21, this question is based on TCS and TDS. In the first question is based on TCS. The second question is based on TDS. The first question says that the assessee is remitting some 5,80,000 outside India for maintenance expenses of his son because his son is doing some education outside India in some university. So on that, he will be liable for what? TCS. Okay. Apart from that, he has also taken a loan from his employer. That is a mistake he has done. He should have taken a loan from a financial institution, because if he take a loan from a financial institution and then he remit outside India for education purpose, in that case, he will get 7 lakh exemption also, and he will also get 0.5% relax rate also. But here he is not going to get 0.5% relax rate. He is doing both the things from the same person only. The authorized dealer is same. Therefore, 5.8 lakhs plus 7.8 lakhs, both of them will come into the same category only. If this 7.8 lakhs is taken from a financial institution in India, then this would have come in a separate category. Then 7 lakh exemption for 5.8 lakhs would have been separate, and 7 lakh exemption for 7.8 lakhs would have been separate. But here there will be only one time 7 lakh exemption considering both the amounts. Okay, 5.8 lakhs plus 7.8 lakhs minus 7 lakhs will be subject to 5% TCS. Second is a case of 194O, that is Amazon wala case. Amazon, and there is a resident seller. The resident seller has sold goods worth rupees 84 lakhs through Amazon, but the resident seller is not ready to give what? PAN and Aadhaar. So in case the PAN and Aadhaar is not given, in that case you are liable to deduct TDS generally at 20%. But in this case and in 194Q, these are the two sections in which if the PAN or Aadhaar is not given, you are supposed to deduct TDS only at 5%, 5%, 5%. So here the e-commerce operator, that is high sale, will deduct TDS at the rate of 5% of 84 lakhs, that whatever amount that comes to. Okay. Next one, question number 22 is the question which is based on NR taxation. Beautiful question. This is the foreign company. It is earning some incomes in India. The first income which is earned in India is income from technical know-how. That foreign company is providing some services to Indian company, and then Indian company is not making the payment in money. That Indian company is giving debentures to the foreign company of 30 lakh rupees. So this debenture is a consideration for the foreign company. So that debenture which is given to the foreign company, that Indian company will be taxed under which section? It will not be taxed under 115A. 115A is not applicable, because for 115A to apply, the foreign company should have an agreement with the Indian company, and that agreement should be approved by central government. Then only 115A is applicable. Therefore, this 30 lakh rupees will be taxed at 40% normal rate. Okay. Now, that debenture which is given to the foreign company is also earning interest on that debenture. That is 2,85,000 rupees. That will be subject to what tax rate? Will that be covered in 115A? That interest also cannot be covered in 115A, because again that loan is not in foreign currency, that is in Indian currency. That will also be taxable at what? 40%, 40%, 40%. So this first point is very, very, very intelligent point. Okay. Second one, the foreign company is invested in some GDR and they are earning 6,50,000 as dividend, and the GDR is also purchased through foreign currency. So this will be covered in 115AC and it will be taxed at 10%. Okay. Next, that foreign company has invested in some Indian company's equity shares. They are earning some dividend from Indian company, that will be liable to tax at 20% and under section 115A. Non-resident or foreign company investing into companies, Indian companies, and earning dividend will be subject to 20% tax. Next one is also an intelligent point. That foreign company is giving some services to Indian company, and in return the Indian company is making the payment for royalty, and that royalty is now approved by central government, and there is an agreement between both of them. So this will come under 115A definitely. But the catch over here is, this is the amount received by the foreign company, and if this is the amount received by the foreign company, this is not the income which is earned by the foreign company. This is the net amount. How much will be the tax rate? 10% will be the tax rate as per 115A, 4% will be the cess as per 115A. Therefore, the tax rate over here will come to how much? 10.4%. Therefore, this amount of 12,56,000 is received amount, and this received amount will be 89.6%. You have to gross it up. Gross it up. Be very careful. Whenever the word receive will come, you have to gross it up. You have to gross it up. So when you gross it up, it will come to somewhere around 14 lakhs, and then you will compute tax at the rate of 10.4%. Next is, you have some business in Delhi on which you are earning 8,50,000 profit, that will be subject to 40% tax. Next is a mistake done by ICI. The long-term capital gains with indexation benefit comes to 132, without indexation benefit comes to 232. Now you have an option, you can take either of the two. So you can take, now what ICI has done, while computing the income they have taken 132, but while computing the tax they have taken 232. Now they cannot take two different amounts now. So you take one of the amounts here. Let's take 232, that would be more beneficial. Paying 10% tax on 232 is beneficial as compared to paying what 20% tax on 132. Therefore we are paying 10% tax on 232, and therefore this is what the question is all about. Now one last question is there over here. I am not doing that. You also don't do that before exam, because it's a copy paste question of DTAA. DTAA questions are going to repeat again and again with same format. Same deductions, everything is same. Don't waste your time. Whenever a different kind of DTAA question will come, I will definitely address that. Otherwise, I am not going to touch a unilateral relief question. Whenever a different question will come, I will definitely touch. If you want, if you have time, you can go through it on the day of exam. Don't waste time. Okay. So let's move on to the next RTP, that is RTP November 2022, and the first question over here is based on section 35AD and AMT, and also on partnership firm. So there is a partnership firm over here who is starting with a new business of 3-star hotel. Therefore, there is an implication of 35AD. Now there are two working partners over here, but there is no information of remuneration to partners. There is only interest to partners, no remuneration to partners. So let us compute the net profit and total income and tax liability of this particular partnership firm. First of all, the depreciation will be added back. The interest which they are paying is 15%. Therefore, you have to add back 3%. So I'm computing 50 lakhs into 3 divided by 15. I'll get the 3% interest. I will add that. Okay. And then the some amount is paid to some person on which TDS is not deducted. So 30% that will be disallowed. Okay. Now apart from that, they have also purchased some motor car of 7 lakh. On that they will get 35AD full 100% deduction. They have also purchased some land and building. Land will not be eligible for deduction, but building will be eligible for 50 lakhs full deduction 100%. And they have also purchased some air condition that will also be eligible for full 100% deduction. After doing all those things, you will get a profit, you will get a loss of 6,60,000 from this particular hotel, but they have also one more 4-star hotel in Mumbai in which there is a profit. So you can set off this loss against the 4-star hotel of Mumbai, and then the net profit finally after that will come to how much? 34,78,000. On that 34,78,000, you'll be paying 30% tax because it is a partnership firm, 4% cess, and then there will be the tax liability which will come as follows. But this is not the final tax liability. In case of other than company, if they claim 3580 deduction, 10 AA or other profit link deduction, they are liable for AMT. So now we are supposed to compute the AMT for this particular company, for this particular partnership firm. How the AMT will be computed? AMT is nothing but total income plus whatever deductions you have claimed in 3580 minus whatever depreciation you can get on those three assets. So on building, I will take 10% depreciation. On motor car, I will take 15% depreciation. And on air condition, I will take 15% depreciation, which is the normal rate. Because in AMT, you get the deduction for the depreciation on 3580 assets. After doing all those things, I will get the adjusted total income, and then I will apply AMT of 18.5% compared with my actual normal tax rate. Normal tax is 10 lakh 85. AMT is 17 lakh, and therefore the differential amount will be considered to be what? The AMT credit, as you can see over here. Okay. So next question is based on a PGBP question where we are supposed to compute the total income and tax liability, and very important point we have to follow here, 115 BAA. So be very careful. This is an Indian company and engage in manufacturing, but because it is following 115 BAA, it will not be eligible for additional depreciation. The very first adjustment is depreciation 2 crore 80 lakhs you will add back. Second one is donation to political party, you will add this back to PGBP income, and while computing the total income from chapter 6A, you will not reduce because in 115 BAA you do not get the deduction of 80 GGB. 80 GGB is not available. In 115 BAA, only 80 JJAA is available and 80 M is available. 80 GGB is not available, so you will not take the deduction of this particular adjustment, okay, in chapter 6A. Next, donation to a certain scientific research association not available in 115 BAA. So you have to add this back. It is not allowed under 115 BAA. Next, you have received some dividend of 15 lakh rupees from a foreign company. So that dividend will be reduced from PGBP and it will be shown under IFOS. And on that deduction, you will get a deduction of 80M because you have declared a dividend of 12 lakh rupees before the due date. Before the due date, you have declared and distributed the dividend. So in ATM, you are going to get the deduction of what? 12 lakh rupees or actual dividend received, whichever is lower. So ATM is allowed with 115 BAA. Yes, as I have told you earlier, in 115 BAA, you get the deduction of 80 JJAA ATM. Okay. Next, you have some long-term capital gains on listed shares on which STT is paid. So this will be reduced from PGBP and it will be shown under capital gains, and it will be subject to 10% tax on 3 lakhs because in 112A you get an exemption of 1 lakh rupees. Okay. Next one is a very important adjustment. You have taken some loan for purchase of machinery. The loan is taken on 1st of June. It means you have to pay interest for 10 months from June to March. So interest of 10 months will come to how much? 35 lakhs. Now out of that, this machinery is put to use in January. The machinery is put to use in January. So from June to January, 7-month interest will be capitalized to the machinery. So out of this 35 lakhs, this 35 lakhs is interest of 10 months. So out of that, 7-month interest will be added to the machinery, and 3-month interest should be allowed as P&L account as a revenue expense, but that will also not be allowed because the 3-month interest is outstanding. It is not paid. Therefore, section 43B will come into picture, and 43B says that interest has to be allowed if it is paid, if it is taken from a scheduled bank, and SBI is the scheduled bank, and therefore this 3 months interest will be what? Disallowed. This 7 months interest will be what? Added to the cost of the machinery. Okay. Next one is you are selling some asset to your 100% subsidiary, and if you sell some asset to your 100% subsidiary, then capital gains is not attracted in respect of such asset. Okay. Therefore, this 8 lakh rupees will be reduced from PGBP and it will not be chargeable as a PGBP income. Okay, it will not be chargeable as a capital gains income. Forget about it. Next one is you are paying some salary of 1 lakh rupees for installation of machinery that should be added to the cost of asset. So add to the P&L account, add to the net profit, and add to the machinery and claim depreciation on that. Okay. Next one is you have sold some goods of 22 lakh rupees, out of which 12 lakh rupees is written off in the books of accounts, and then remaining 10 lakh rupees is recoverable. Now suddenly the debtor died, he expired. Therefore, the remaining 10 lakhs should also be what? Claimed as a deduction under bad debts because that is not going to be received now. Earlier you sold 22 lakhs, out of which 12 lakhs is written off. Now the remaining 10 lakhs will also not be received because the other person is dead. Therefore, reduce 10 lakh rupees. That is the adjustment for this particular adjustment. Next one is you can claim 1 crore 50 lakhs as your depreciation as per income tax law, and then you can claim 5% depreciation on office building because it is used for less than 180 days. You can claim 40% depreciation on computer because it is used for more than 180 days. And on machinery, you have to be very careful. 50 lakhs is the basic cost of the machinery. Plus 100 lakhs, you have to add back what? 50 crores is the basic. 50 crore is the basic cost of the machinery. Plus you have to add this 1 crore rupees as a foreign technician, which you have to capitalize. Plus you also have to add the interest, pre-use interest, that is 24.5 lakhs, which you have computed. And on that amount, you are going to claim depreciation at the rate of what? 7.5% because it is used for less than 180 days. You are not going to get deduction of what? Additional depreciation. Forget about it. Okay. Now this is what this question is all about. And once you do this, you will apply what? The tax rate. okay? On 1128 income on 3 lakh, as I have told you earlier, 1 lakh exemption, you're going to get 10% tax, and balance income 1128, 22% tax, 10% surcharge, flat, always on 1128 income, okay? And 4% cess. Now, next question. Question number 26 is based on a question of REIT as well as AIF. There is one person, Mr. Rajesh, who is holding 10% equity in a REIT. Shipra is REIT and PQR is AIF. Now, we need to compute the taxability of this particular income in the hands of Mr. Rajesh. And one important thing, Mr. Rajesh is following what? Mr. Rajesh is following 115 BAC. So we have to compute his tax liability as per the alternative tax regime 115 BAC. Be very careful. Now, Shipra is a REIT. And now, if you receive a dividend income, one more important thing. In case of REIT, the income is taxable in the hands of investor on payment basis. Whatever REIT has distributed, that will be taxable in the hands of investor. In case of AIF, the income is taxable on accrual basis. Whether REIT has distributed or REIT has not distributed, whether the AIF has distributed or AIF has not distributed, it doesn't matter. It will always be taxable in the hands of AIF. Always be taxable in the hands of the investor. So in case of REIT, if the REIT is earning 100 rupees and distributing 90, then 90 is taxable in the hands of investor. In case of AIF, if the AIF is earning 100 and distributing 90, still 100 will be taxable in the case of AIF. Now, first thing is, we'll talk about the REIT implication. The first is dividend from GPL. GPL is SPV and SP is not following 115BAA. If SPV is not following 115BAA, then the investor is not liable to tax. If SPV would have followed 115BAA, then investor would have paid tax on that dividend income. Okay. Next, interest income. Interest income, the SPV, the investor will be liable to tax on how much amount? Total interest is 3 crore. Out of which how much is distributed? Only 90% is distributed. That is 2.7 crore. Out of that, I am only 10% shareholder. Therefore, only 27 lakhs will be taxable in my hand. Then the company and the REIT will also deduct TDS at the rate of 10% on that under 194 LBA, and therefore I will get the credit of 2,70,000 over here. Okay. Next. What about the short-term capital gains? On short-term capital gains on sale of development properties, the REIT will pay tax at MMR. Investor is not liable to pay tax. Let's talk about AIF now. Business income, AIF will pay tax, investor will not pay tax. Losses of 27 lakhs will be carried forward by the investor because investor is holding the shares for more than what? 12 months. If the investors are holding the shares for at least 12 months or more, then the investor will carry forward. But in this question, there is no long-term capital gains. Therefore, we are not able to set off this 27 lakhs of long-term capital loss. If there would have been a long-term capital gains, we would have set off this 27 lakhs against that long-term capital gains. Okay. Now, this 52 lakhs. This 52 lakhs will be what? This 52 lakhs is interest income. Now, this interest income will be taxable in the hands of the investor on the basis of what? Not on the basis of distribution. 10% directly, whether distributed or not distributed, directly 10% of that will be taxable in the hands of the investor. Therefore, 5,20,000 will be taxable in the hands of the investor, and 10% TDS will also be deducted by the company. Okay. And therefore, then you have to compute the total income. On that, you have to apply 115 BAC. 115 BAC is applicable in this particular case, and you will take the credit of these two TDS, and net income will be, net tax will be payable by the assessee. Okay. Question number 27 is based on what? Is based on TDS and TCS provisions of the income tax law. Now, the very first question over here is about what? There is an Indian citizen, and if you compute the residential state of this status of this person, then this person is a non-resident. Now, remember, if a non-resident is coming to India on a visit, and if he is making some payment to tour operator, etc., then 2061G is not applicable. There is a specific CBDT circular. You can go and check in our easy notes also. It is mentioned in the easy notes. So, if a non-resident is coming to India for a visit, then 2061G is not applicable for that non-resident. Okay. Second question is what? Second question is based on 194Q and 2061H. Always remember, between 194Q and 2061H, always give preference to 194Q first and then 2061H. But in this question, 194Q is not applicable because the buyer is the first year of business. Buyer has a first year of business, therefore the last year's turnover is 0. Therefore, for buyer, 194Q is not applicable. For seller, 2061H may be applicable. How? The seller's last year turnover is more than 10 crore. Yes. And seller is purchasing the goods in the current year seller is selling the goods in the current year of more than 50 lakhs. So, seller will be liable for what? Collecting TCS. Now, in TCS under 2061H, TCS is not collected on accrual basis. TCS is collected under 2061H on receipt basis. And the receipt is happening 1 month after the sale. So, the sale is happening on 1st of August, receipt is happening 1 month after, sale is happening on 15th of September, receipt is happening after 1 month, after 1 month. So, on this 25 lakhs is not liable to collect TCS because TCS is applicable above 50 lakhs. So, now on the second sale, the 50 lakh limit is crossing. So, how much limit is crossing? 5 lakh is crossing. So, on the second sale, on 5 lakhs, he will collect TCS at the rate of 5%. So, when he will collect, when he is liable to pay, he is liable to pay 1 month after the date of sale. Okay, because the payment is received 1 month after the date of sale. It is written in the question in the last line. Okay, now last question, last point. 15 lakhs is the sale on 15th of December, but the payment is not received on 15th of December. The payment of receipt is 1 month after that. That is on 15th of Jan. So, on 15th of Jan, he will collect 0.1%. That is 1500 rupees. So, on 15th of October, 5 lakhs 0.1%. On 15th of Jan, 15 lakhs 0.1%. TCS will be liable for the seller in this particular question. Okay. Now, the next question is also a very good question. Question number 28. Mr. Ravi Prakash is a person whose wife, Mr. Sudha. Mr. Sudha does not have any great income. Her income is less than 2,50,000 rupees if you compute the total income of Mr. Sudha. So, Mr. Sudha is saying that I am not liable for what? Filing the return. Absolutely correct. But Mr. Sudha has done one transaction. She has purchased one car of approximately 26 lakh rupees. Okay, ex showroom price. On ex showroom price, TCS is collected. So if you purchase a car of more than 10 lakh rupees, then you are liable for TCS. So if a person is purchasing a car of 26 lakh rupees, how much TCS will be collected? TCS of 25 lakhs will be collected. Sorry, TCS of 25,000 will be collected. That is 1% TCS under 2060(1)(f). So do you remember that there is a specific provision made through a circular and through a separate rule, which says that if any person who is not liable to file the return, but his TDS or TCS is 25,000 or more in a financial year, then that person is also liable for what? That person is also liable for what? Filing the income tax return. As you can see over here, if a person's TDS or TCS is greater than or equal to 25,000 rupees, then that person is also liable for what? Filing the return. So that is what they have tested over here. That small circular, that small rule is tested over here. Therefore, Ms. Sudha has to file the income tax return because her TDS and is exceeding 25,000 rupees. If it is 25,000 or more, you are liable for what? Filing the income tax return. Now, question number 29 is same as what we have done earlier. That is of Lakshman Das Khandelwal case law, which we have done earlier also in the previous RTP. So, I am not repeating. Question number 30. In question number 30, what is happening? There is an assessee whose total income is 28 lakhs. And in the assessment order, the AO has increased the assessment by 5 lakh rupees. Now, he wants to go to DRP. Can he go to DRP? Against him, there is no order of detention. There is no prosecution made. There is just a penalty which is imposed under 271D. That is all fine. Okay. That is all fine. There is nothing wrong in that in imposing the penalty. Now, there is one provision of DRC, Dispute Resolution Committee. Can he go to Dispute Resolution Committee? Who can go to Dispute Resolution Committee? A person whose total income is up to 50 lakhs. Tick. And the AO does not increase the income more than 10 lakhs. Tick. AO is increasing only 5 lakhs. And there is no order of detention against him. There is no prosecution against him. Tick. There is no need for penalty. If penalty is imposed, that is all fine. No imposition of penalty is not a condition mentioned in DRC. So he can go to DRC. Within how much time? He can go to DRC within 1 month. Within 1 month from the date of the specified order. So 26 November 2023 was the date of order. So within 1 month means he can go till 25th of December 2023. Now, once the DRC has passed the order, can he appeal against the DRC order? Against the DRC order, appeal is not possible, not possible, not possible. Last question but not least. If the assessment order is based on the information received with DTAA with country X, can he go to DRP? Then he cannot go to DRP. Very specifically, it is mentioned in 245 MA that if the assessment order is based on the information from DTAA from foreign country, then the DRC provisions are not applicable, not applicable, not applicable. Okay. Next question, question number 31 is a very beautiful question which is based on equalization levy. Now, there is an equalization levy section 165A, which says that if there is an e-commerce operator who is providing some services and he does not have a P in India and his turnover from India is 2 crore rupees or more, then he's liable for what? Equalization levy. So we need to check all these things. And the services which he is providing should not be in the nature of royalty and FTS. If it is in the nature of royalty and FTS, equalization levy is not applicable. Be very careful. Now, .inc is a non-resident? Yes. Does he have a website? Yes. Does his turnover is 2 crore or more? Yes. Is he having a P in India? No, he does not have a P in India. Condition number 4 is also fulfilled. And is he providing a services in the nature of royalty and FTS? He is not providing the services in the nature of royalty and FTS. The reason is, if you purchase a license of computer as an end user, the Supreme Court has said that in the case of Engineering Analysis Center of Excellence, that if you purchase the license in the form of an end user or to resale, then it is not a royalty, not a royalty, not a royalty. And because it is not a royalty, the non-resident is an e-commerce operator, his turnover is 2 crore or more, and he does not have a P in India, therefore he is liable for equalization levy at the rate of 2%. Okay. The next question is not something which I am going to do. That is based on DTAA question, so I am not much interested in that particular question. It is similar to what we have done in the previous questions. You can see the previous question once. You do not see DTAA question again and again. Anyways, you do not have time on the day of examination. Okay. And the last question in this particular RTP is, you are entering into a DTAA with country X, and in that case you are saying that you are entering into force on 1st of Jan 2019. In that case you are saying that DTAA, as per DTAA with country X, the dividend will be taxable at 15%. Okay. And that country is a country with OECD member. Who is an OECD member? Now, the next country with which you are entering into DTAA, after that you are saying that it is subject to 10% tax. Now this is wrong. Initially you entered into DTAA with country X and then at 15% DTAA rate, dividend rate, and then you entering into a DTAA with another country and giving a further relaxed rate of 10%. So both the countries are most favored nation and both the countries are OECD members since the very beginning, and therefore you have to give this benefit of 10% to the first country also. This is what the concept of most favored nation is all about. Now, in this question, if it is said that the second country, the first country became the member of OECD, the second country became the member of OECD in 2021, then this benefit will not be given because that particular country is not a member on the date on which we gave the benefit of 10% to the first country. Okay, so this is what this question is all about. Nothing great as such, as you can go through it once. Okay, now this question is more relevant in paper 60 rather than paper 7. So let's move on to the RTP May 2023, and in this RTP the first 15 questions are MCQ, which I have already discussed and put on YouTube. You can check in full English also. So I'm interested in explaining and revising the descriptive questions over here. First question is question number 16, which is a question which is based on Finance Act 2022 amendment. If you realize that this is an amendment, there is an amendment which came in Finance Act 2022 which says that if you have taken a loan from someone and if you're not able to explain the source of the loan in the hands of the lender, then it will be taxable in your hand in the form of cash credit. So in this case, a partnership firm has taken a loan from what? Its partner. Now, it is the duty of the partnership firm to explain the nature and the source in the hands of the partner also. If the firm is not able to explain the nature and source in the hands of partner, then the firm will be liable for tax under section 115 BBE, and 115 BBE is liable for how much tax? 78% tax, and therefore the assessing officer is attracting 78% tax because the partnership firm is not able to explain the source in the hands of the partners, from where the partner has got the money to give the money to the firm. Okay, so this is what this first question is all about. Let's move on to the second question. Question number 17. This is also based on what? Finance Act 2022 amendment. Very important amendment. It is very clearly written in the provision of section 43B, which says that if you take a loan from a financial institution and if there is an outstanding interest, then that outstanding interest is not allowed as deduction unless and until you make the actual payment. Now, can I convert that outstanding interest into a new loan and take the deduction? The answer is no. Can I convert that outstanding interest into a debenture or any other security and take the deduction? The answer is no. This is the amendment which is made by Finance Act 2022. So in this question, the assessee is taking a loan from a financial institution and converting the outstanding interest into a new debenture. That will not be allowed as deduction unless and until it is actually paid to the bank or financial institution. It will not be allowed as deduction. Okay, so this is what this question is all about. Now, question number 18 has 5 different parts which says that you have to identify whether the assessee is liable to file the return or not. So let's see whether the assessee is liable to file the return or not. Mr. Albert is there. His age is 31 years and his total income is just 2 lakh rupees. So by default, he is not liable to file the return. But because his turnover of business is more than 60 lakh rupees, he is liable to file the return. Do you remember that there is a separate amendment made by Rule 12BA or something like that? A circular was introduced by CBDT. It is also given in our easy notes. You can go and check over there that if your business turnover is more than 60 lakhs, you are liable to file the return. So because of that, the assessee is liable to file the return. Second, Mr. Aarish, aged 42 years. Now he is liable to file the return by default because his PGBP income is 2.5 lakhs and his interest income is 4,50,000 rupees. So his gross total income is 7 lakh, and any person whose gross total income is 7 lakhs is liable to file the income tax return. Now the third and fourth case is also very simple. Third case, there is a partnership firm, and in fourth case, there is an XYZ private limited company. And we all know that for a partnership firm and for a company, it is always mandatory to file the return irrespective of the total income. So these two assessees are liable to file the return. Now the fifth case is a very intelligent case. In this, there is a person, Mr. Valish, whose age is 58 years. He has deposited 50 lakhs in saving bank account. Do you remember that? If a person deposits 50 lakh rupees in saving bank account, then he is liable to file the return. If he is depositing 50 lakhs or more in the saving bank account, he is liable to file the return irrespective of whether his total income exceeds what? Exceeds 2,50,000 or not, it doesn't matter. Okay, so by that default, by that logic, he is liable to file the return. Is he liable to file the return under the normal provision? No, under the normal provision he is not liable to file the return because his total income is less than the basic exemption limit. But as per the special provision, he is liable to file the return. Okay, now next question, question number 19 is based on search and seizure, and it is a very intelligent question. On 17th of April 2022, there is a search. Okay, and the assessing officer found for 16-17 PY 23 lakh shares and for 17-18 PY 25 lakh shares. Now, for how many years he can send the notice? He can send the notice 3 years from the end of the relevant AY in normal cases. In special cases where the escaped income is 50 lakh rupees or more and it is represented in the form of assets like shares, land and building, advances, deposits, then it can issue notice up to 10 years. So now this does not come in the special case. Why? Because the total income which he has found does not exceed what? Does not exceed 50 lakhs. It is only 48 lakhs. Therefore, he cannot issue notice beyond 3 years. Now, what if this 23 lakhs is not 23 but it is 30 lakhs? This is part 2. If this 23 lakhs is 30 lakhs, then his escaped income will be more than 50 lakhs. Then in that case, he can issue notice even beyond 3 years. Okay, he can issue notice up to 10 years. Next, part 3 says that what if the AO has found that there was some expenditure of 52 lakhs incurred on the marriage of the daughter in previous year 16-17? Can he issue notice up to 10 years in that case? Yes. If there is an expenses or if there is an entry in the books of account, this is also a very latest amendment which was made in the last year only, that if there is an asset or if there is an expense or if there is an entry in the books of account, in either of the case, if it is of 50 lakhs or more, you can issue notice up to 10 years. This is what this question is all about. Okay. Now, next question is a very intelligent question and there are multiple parts in this question. If you go and see the solution, you will go mad that there are so many parts in this question. Question number 20. Now, let me give you a synopsis of this question. This question is on cooperative society, and cooperative society is engaged in marketing of agricultural produce grown by its member. Therefore, it is eligible for what? ATP. And a cooperative society which is engaged in the marketing of agricultural produce is eligible for ATP. Now, there are multiple provisions conditions which we have to follow. First thing is there is a 10 new employees are employed by cooperative society of 20,000 salary. So they will be eligible for 80 JJAA deduction. Okay. Now all the employees are paid by account paycheck. Therefore they are eligible for 80 JJAA. There is no issue in that. Apart from that, the profit from agricultural income is 60 lakhs and profit and the interest on fixed deposit is 32 lakhs. Now be very careful. They have asked us to compute tax as per the normal provision, as per 115 BAD also. They have told us to do everything. So the first possibility is compute tax as per normal provision, and if you are computing tax as per normal provision, you also have to compute AMT. When you compute tax as per normal provision, the first thing which you will take is PGBP 60 lakhs, and second thing is interest on fixed deposit 32 lakhs. And what deduction you will get? You will get deduction under 80 JJAA and you will get deduction under ATP of 60 lakh rupees. Compute tax as per the normal provision. Okay, and as per the normal provision, the slab rates you all know that up to 10,000 no tax, about 10,000 10%, then 20%, then 30%, so on and so forth. Okay, up to 10,000 10%, sorry, about 10% to about 10,000 20%, and about 20,000 it is 30%. Okay, now when you will compute the AMT, at the time of computing the AMT, you have to compute the adjusted total income. While computing the adjusted total income, you will add back 80 JJAA, but you will not add back ATP. Why? Because ATP is not liable for MAT. ATP incomes are not liable for MAT. Therefore, you will not add back ATP while computing AMT. One more thing to be kept in mind while computing AMT is now chargeable at 15% for cooperative society. By Finance Act 2022 amendment, cooperative society will be liable for AMT at how much rate? 15%. Be very careful. That is also an important issue over here. Okay. Next. Then you will compute tax as per 115 BAD. When you will compute tax as per 115 BAD, be very careful. You will not compute AMT because an assessee opting for 115 BAD are not liable for AMT. 115 BAD tax rate is 20%, 22%, 10% surcharge, 4% cess. Okay. Now, when you will compute tax as per what? 115 BAD. When you will compute income as per 115 BAD, in 115 BAD, you will get 80 JJAA, but ATP is not allowed. Only one chapter 6 deduction is allowed in 115 BAD, that is 80 JJAA. ATP is not allowed in 115 BAD. Now, the third possibility is we are supposed to assume that it is not an agricultural cooperative society, but it is a banking business. Suppose it is a banking business. That too, it is not an agricultural banking, not a primary agriculture credit society or primary cooperative. You are supposed to assume that it is not a banking company which is eligible for ATP. It is a normal banking company. So again, you have to make two computation. First as per normal provision and then AMT. When you will compute as per normal provision, you will take 80 JJAA. ATP is not now available only. Not available only. It is only available to primary credit society or for these kind of banking industries and not to others. Normal banking industries are not eligible for ATP. So compute normal computation. Take 60 lakhs, take 32 lakhs and take 80 JJAA. Do not take ATP. While computing AMT also, you will add back 80 JJAA. ATP is not there only. Anyways, it would have been then. Even then in AMT, we do not add ATP. ATP is not added back in AMT. Then compute your tax. Okay. Now, the fourth possibility, now assume it is 115 BAD. 115 BAD, when you will assume that, again you will add back only 80 JJAA because ATP is not there only, and you will compute 22% tax. And then you have to take a decision which is more beneficial. You can go through the solution. It's a very important question according to me. ICI can test on this question in your exam. Be very careful. Okay. Next question is based on 10AA. There is a limited liability partnership LLP, and this LLP has two units. Unit 1 is SEZ unit. Unit 2 is a domestic tariff area. Therefore, for unit 1, you will get deduction under 10AA. But while computing the tax liability, you have to compute the tax liability of the entire LLP. Now, therefore, the total income of LLP will be how much? Unit 1 has a profit of 710. Unit 2 has a profit of 840. Now, you have to disallow certain expenses because those are not as per the income tax law. So, in unit 1, you have to disallow 41 lakhs. Therefore, profit will become 751. And in unit 2, you have to disallow 55 lakhs. Therefore, profit will become 840 plus 55. This will be your total income. So, what will be your total income? 710 plus 41, 840 plus 55. This will become your total income. After you are computed with your total income, what are you supposed to do? You are supposed to take deduction under 10AA, and 10AA deduction is available how much? Profit into export turnover divided by total turnover. Now, what is the profit of unit 1? Unit 1 profit is 710 plus 41. Therefore, unit 1 profit is 751. But from profit, you have to remove two things because those two things cannot be part of profit. That is duty drawback cannot be part of profit, and profit on sale of import entitlement license. We have done all these things in 10AA. You can go and check. You are not eligible for these two things. Okay. Then you have to compute the export turnover. Export turnover includes only those turnover which has received in India in convertible foreign currency. How much is received? 1600 is received. Now, out of 1600, 180 rupees is what? 180 rupees is what? 180 rupees is with respect to what? Out of 1600, 180 rupees is with respect to insurance and freight, and therefore insurance and freight will not form part of what? Export turnover. So out of 1600, I am removing 180, therefore my export turnover is 1420. Similarly, my total turnover is how much? Export turnover is 1800, domestic turnover is 300, total turnover is 2100. Again, out of total turnover, you are not supposed to take what? You are not supposed to take freight and insurance. Therefore, freight and insurance in total turnover is how much? It is 300. So I am removing 300 from here. Therefore, my total turnover is 1800. If I multiply this, I will get my deduction as 525.4. I will take the deduction, I will compute tax at 30%, and then I will apply surcharge also if applicable, because surcharge is applicable according to me over here because the income is more than 1 crore. Now I will also compute AMT now. While computing the AMT, what am I supposed to do? I will add back 525.4 to get the adjusted total income, and then I will apply 18.5% plus surcharge if applicable and cess of 4%. Okay, so this is what this question is all about. Now next question is based on computation of total income and tax liability, that too as per 115BAA. We have to follow 115BAA over here, but in this is the manufacturer assessee, but in 115BAA, even if you are manufacturer, you are not going to get the benefit of what? Additional depreciation. So let's see one by one all the adjustments, assuming that we are supposed to do the question based on 115BAA, not as per the regular provisions of income tax. First thing is the income tax. The opening stock is overvalued by 10%. It means the opening stock is 110%. So divide by 110% and add back to the pre-P&L account. And the closing stock is undervalued by 10%. It means the closing stock is 90%. So divide by 90% and add back closing stock also. So adjust this in your net profit. Okay. Next is you are buying some intangible assets of 65 lakhs on 15th October. So you have to add back this intangible asset and you have to take 25% depreciation on that. That too you have to take what? 50% of that, because it is used for less than 180 days. Intangible assets are subject to depreciation. They cannot be directly deducted from P&L account. Okay. So that's what I'm doing over here. Next one is 112A. You have purchased and shares for 85 rupees, and then on 31st Jan the value of the shares is 195. This is the case of what? Listed shares. 112A will be applicable over here, long-term shares. And then when you are selling for 220. So you have to suppose to find out the grandfathering has to be applied over here. So first you will compare the FMV as on 31st Jan 2018 with selling price whichever is lower, and then you will compare with the actual cost whichever is higher, and therefore the cost will come to 195. The cost is 195, the sale consideration is 220, and if I compute the capital gains will come to 55,000. Now because the capital gains is less than 1 lakh rupees, it is not liable to tax, because in 112A you get an exemption up to 1 lakh rupees. Okay. Next, electricity charges of February and March is not paid. It doesn't matter. Electricity charges are not covered in 43B. It will be allowed based on what? Accrual basis also. There is no need to make any payment. Next, there is an hedging loss on purchase of raw material. It will be allowed as a PGBP expense, and PGBP deduction will be allowed on that. Depreciation has to be added back as per books of account. Then dividend from foreign company has to be reduced from PGBP and show under IFOS. Then non-compete fees which you have received is a part of PGBP. Let it be part of PGBP. Non-compete fees is a PGBP income only. Next, you have forfeited some amount on sale of land, on negotiation of transfer of capital asset. You have forfeited some amount. Do you remember that? If the amount is forfeited after 1/4/2000 on or after 1/4/2014, then that is considered to be IFOS. So reduce from PGBP and show under IFOS. And if it is forfeited before 31st March 2014, then you have to reduce from the cost of acquisition. Now, in case of unlisted shares, I'll talk about that in a while. Next, you have purchased some machinery of 70 lakhs and you have put to use in the month of November. And there is also a loss of foreign currency on that machinery. That machinery is imported. So if there is an imported machinery, imported asset on which there is a foreign currency loss, that has to be adjusted in the block of asset as per section 43A. So 70 lakhs is the cost of machinery, 2 lakhs is the exchange loss, and therefore the cost will become 72 lakhs. On that, you will take 50% depreciation, 7.5%, because the machinery is put to use in the month of November, and no additional depreciation will be allowed. Depreciation as per the normal provision will come to 35 lakhs, and then the next one is just an information. The next one is 80JJAA. Do you get 80JJAA in 115BAA? By default, you would have by hearted with this particular thing that in alternative tax regime, you get the benefit of 80JJAA. There are 59 employees, out of which 36 are employed from 1st June 2022 and at 15,000. So they will be eligible. But out of this 36 also, 10 employees are not eligible because their salary is paid by bearer check. If the salary is paid by bearer check, it is not eligible. Therefore, only 26 employees are eligible. The rest of the employees are not eligible. Either their emoluments is more than 25,000 or they are employed for less than 240 days. So only 26 employees are eligible out of 36 employees. The rest of the employees are not eligible only for the purpose of 80JJAA. Next, unlisted shares were acquired at 80 lakhs. Now be very careful. Unlisted shares are acquired at 80 lakhs and you have a profit on sale of 18 lakhs. Therefore, profit is 18 lakhs and purchase price is 80 lakhs. Therefore, the sale consideration will be 98 lakhs. Okay, this is how you have to compute. Backward, you have to go and compute the sale consideration, and then you have to index the cost of acquisition. The cost of acquisition is 80 lakhs. You have to index that, and that will be chargeable at 20% tax. Okay, and the rest of the income will be chargeable at 22% tax, plus all entire tax will be subject to 10% surcharge and 4% cess as per 115BAA. Next one is the same question which we have done earlier. You can go and check the chapter. Which chapter? Not chapter. One of the RTPs we have done in this session only. You can go and check that it is exactly the same question. I am not interested in doing this question again and again. You also don't do this question now for the second time before the day of exam, because it's a repetition of the entire provision. Okay. Now, the next question is question number 24. Question number 24 talks about what? The transfer pricing. There is a non-resident with whom we are doing some transaction. Okay. Now, that non-resident who gives us a guarantee of at least 12%. So, if one entity gives a guarantee of loan of 10% or more, then both of them are deemed to be associate enterprise. Therefore, this transaction is what? Is deemed to be international transaction. Why? Because one of the entity is non-resident and the transaction is in the nature of purchase, sale, service, etc., etc., and that one entity is giving guarantee of 12% to the other entity, therefore both of them are deemed to be associated. Therefore, transfer pricing is applicable in this transaction. Now, the second part is saying that suppose if the primary adjustment of 310 lakhs is made by the assessing officer on 1/4/2022, then and the assessee has not repatriated that money till 31st March 2023, then what are the possible options that are there with the assessee? The first option is there, he has to pay interest. Secondary adjustment will be applicable, because if on 1st April 2022 AO is doing primary adjustment, assessee should have brought back that money within 90 days from 1st April 2022 in India. If he is not bringing that money, he will be chargeable for interest from 1st April only. For the entire year, interest will be charged at how much percentage? Because the transaction is in INR, SBI marginal cost of lending rate plus 3.5%. Therefore, the interest rate will come to 9 plus 3.5, that will come to 12.25%. Therefore, on 310 lakhs primary adjustment, you will be liable for 12.25% interest. Pay that. Second option is what? For the entire year, because the interest will be counted from the date of order and the order is passed on the very first day. The second option which you have is pay additional tax at the rate of 20.9664, that is 18% plus 12% surcharge, 4% cess, and you will be relieved from tax interest. You will be relieved from secondary adjustment from the date of payment of additional tax. Okay. And one last question is over here. This will complete all the RTP. This is based on what? DTAA question. Don't see that. That is a very simple question, a repetition of what we have done earlier in the previous paper. Now, a lot of things will repeat. Whatever will repeat, we are not going to do that. Neither I am going to do that, nor you are going to do that. Okay. It doesn't make sense to repeat the thing, because on the day of exam, we are short of time. Okay. So that's it. This is what the RTP is all about. All 6 RTPs, including the latest RTP, May 23, we have done it. For November 2023 attempt students, I will put separately whenever the November 23 RTPs will come. Okay. So I'm just stopping the lecture here, as you all have requested that, sir, give us the lectures in parts, sir. First give us, sir, what? First give us the RTP, at least give us the RTP. So today I am uploading the RTP videos. So in 2 days I'll upload the MTP videos, and in another 2 to 3 days I will also upload the past papers. If time does not permit, at least see RTPs and MTPs at least, if you're not having a time to see the past paper. Past papers can be ignored, but at least RTPs and MTPs has to be seen, because questions might repeat from this. There are high chances. From past paper, the questions might not repeat in the same form. They might change the portion and then they will ask. Okay. So if you will have liked the lecture, so please share with this with all the South Indian students who are struggling to understand the Hindi videos which are there on YouTube. So I am doing my best for you all to put all the videos in English also simultaneously. It's a very difficult task for me also to record same thing twice, again and again. It's a very, very irritating thing. But that irritation I'm ready to take if thousands of students are benefited because of that. I'm here to take that irritation for you all. Don't worry about it. But you also can do that much favor for me, that you can share it with maximum students. And please, even if you like one of the questions of this particular RTP, please have a good and beautiful comment below. Okay. Take care all of you. Bye. See you soon fast with what? With the latest mock test paper. 8 mock test paper we are going to discuss, including May 23.